You're watching Silver News Daily. Subscribe for more.
The global financial system is standing on the edge of a cliff, and almost no one is ready for what comes next. Decades of reckless money printing, unsustainable debt, and blind faith in fiat currencies have created a ticking time bomb, one that's about to detonate. We are witnessing the rejection of the entire debt-based system, a crisis so massive that even central banks are scrambling for cover. The warning signs are everywhere, bonds are collapsing, inflation is relentless, and the so-called safe investments of the past are failing. But here's the part most people don't see. Amidst this chaos, silver is quietly positioning itself for an explosive breakout. Think back to history. Every time fiat money crumbles, real assets rise from the ashes. In the 1970s, gold and silver soared as stagflation gripped the economy. In 2011, silver rocketed toward $50 an ounce. But this time, the setup is even bigger. The gold-to-silver ratio is flashing a massive buy signal. Industrial demand is surging, and physical silver shortages are starting to shake the markets. While most investors remain blind to what's happening, those who understand history know exactly where this is heading. Francis Hunt has been warning about this moment. The moment when debt implodes, fiat collapses, and silver enters a bull run unlike anything we've seen before. The pieces are already in motion, and the window to act is closing fast. So how did we get here? Why is the debt system collapsing now? And most importantly, what does this mean for silver's price potential in the years ahead? Stay with me, because by the end of this, you'll see exactly why the greatest wealth transfer in history is happening right now, and why silver is at the center of it all.
You for that, and thank you for remembering that we also called for the 3,000 to be pretty imminent, and that's transpired. And what we've actually seen is the right sizing of America. That people are starting to get more clarity on policy on the new administration, which was actually incredibly limited. They didn't have the wiggle room. In fact, Janet Yellen stood down with almost an after me the storm type statement. You're going to need emergency measures from here, on the basis that the debt markets had been very, very violently rejected the tail end of 2020 and have sold off for the better part of 3.5 years. I'll always start there, and there's a reason, because if people understand the dollar is not in isolation, it's borrowed into existence. So the foundational level is in fact debt. So you have a UST stroke USD system in America, and in the UK you have a gilts or a UK GB 10-year stroke pound, and so every nation is like that. When you get the heavy rejection of the asset class or the reserve asset class, and there was a lot of dropping of that phrase in recent politics, as a debt instrument, which is the 40-year bull market that has ended, what you're actually getting is a rejection of the entire fiat and debt system. However, because rates spiked, it's not immediately apparent, because you actually had relative dollar strength over the last 6 months as a result of the higher rates that were in existence on the debt system. And that's kind of hides the fact that the debt was in a chronic collapse. And the key thing about the debt markets in 60-40 portfolios and everything as an investment is that it was stable, boring market. Bonds are meant to be boring. They meant you create the alpha with 60% in the equities, and when the equities went down, money flushed into the bonds, and you'd get a couple of percent over inflation in real term growth, and you'd get paid a little bit of a yield as well. So bonds would outperform a little bit. They were kind of counter-cyclical. It would balance out the volatility, meaning on a risk-adjusted, volatility-adjusted basis, the 60-40 portfolio was actually a better performance than being 100% equities. Now, that 60-40 portfolio model actually took over from a model that used to have gold in it, which was the insurance against proliferate governments. And of course, they said this isn't required anymore. It underperforms, it doesn't pay any interest, etc., etc. We had Gordon Brown's bottom, which is known as the Brown bottom, where he sold or changed the name on the clipboard at least, all of Britain's gold, or 400 tons thereof, at about $253. So what we've had in the post CV19, this is the setup, is since the rejection in values, you can't have a 45-50% correction in bonds. It hasn't given you what equity markets has. It hasn't done an Nvidia or a Mag 7. This is a rejection of the system. So the rates gave you the dollar strength that masked that for a while, and it reduced the inflation slightly on imported goods for Americans. But in actual fact, the reserve asset as an investable reserve asset has now been rejected. And this has been, okay, so what do we invest in since? We've got hyper-valued equity market.
For over 4 decades, the global economy has been propped up by an ever-expanding mountain of debt. Governments, corporations, and consumers alike have operated under the illusion that debt can grow indefinitely without consequence. But that illusion is now shattering. The bond market, once considered the bedrock of financial stability, is in freefall. Investors are no longer willing to finance reckless government spending at artificially low interest rates. The result? A violent rejection of the entire debt-based system. This isn't just a market correction. It's the unwinding of a 40-year experiment in monetary manipulation. For decades, central banks controlled the narrative, keeping interest rates artificially low to fuel endless borrowing. This strategy worked until it didn't. Now inflation has forced central banks to tighten monetary policy, sending bond prices plunging and interest rates soaring. But here's the real danger. The system is so leveraged that it cannot survive in a high-interest rate environment. The U.S. government alone is paying nearly $1 trillion in annual interest payments, more than the entire defense budget. This is a death spiral. And yet, despite this chaos, the U.S. dollar has appeared strong, temporarily. Higher rates have made the dollar more attractive relative to other fiat currencies. But this is a mirage. The debt system is already breaking down, and history tells us what happens next. When confidence in debt evaporates, investors flee to real assets. This is why central banks have been quietly accumulating gold at record levels, positioning themselves for what's coming. But the metal that stands to gain the most isn't gold, it's silver. The debt collapse is setting the stage for silver's long overdue breakout, and the next phase of this crisis will reveal just how undervalued it really is.
Will maybe get flushed out by being a little bit too little too late in terms of they weren't with our original call in 2020, and the dollar is going to soften. We've already seen that. The euro is going up, but not because of anything amazing Europe is doing, because of relative over weakness needed on the dollar, and Trump needs that for bringing jobs back. Another economic point, and I'll stop after this because I'm getting a lot out here, is that to really avoid what's happening, Trump actually wants manufacturing to return, and the West allowed too much of their manufacturing to go offshore. So the globalization is being reversed, the bifurcation and all of that. So he needs a weaker dollar to help make American workers more competitive with that which already exists in China. And that will help, as well as getting more people to buy locally to help fix the trade deficit and all of these aspects. So what we're going to see is a little bit of circling of the wagons, the lager effect, and a bit of nationalism. And that's where tariffs comes in, because essentially he's making Chinese goods more expensive to try and make the possibility of that being manufactured locally. So you're seeing a financial war play out, and it's everyone for themselves when the chips are down, which is why the relationship with Europe is fraying. Because if we go back one more time and just show you this, the key thing that gave the America so much hegemony is they paid for so much. They paid for so much in terms of NATO. If you look at the defense spending here, in terms of NATO, this particular pie diagram over here has America's contribution as high as 70%. 70.5%. This one over here has it at around 66.6. So depending year to year, I can't tell you which one is the most up to date, but the US spends too much on military. They're also spending too much on interest. They can only do so much. So they're looking to refinance the 9 trillion in rollovers at a lower rate to help not see that interest payment blow out too much further. 1.3 trillion is still better than 1.5. They also need to stop spending money supporting being a de facto backstop for a European underinvestment in defense. And that is why you're hearing talk of pulling out of NATO, reduced funding maybe in the UN could also come up, or renegotiating NATO and the UN given its expenditure. You've also seen Trump say, we're going to spend half. If we can get Russia and China to spend half what they're spending on defense, we'll spend half. Why is he looking to do that? Because he wants them to stop threatening them with greater expenditure so that he can cut as well. So this is about the credit card being pulled, the bottomless overdraft days being over. Let me let you respond to that.
Gold has always been the ultimate safe haven asset, the one metal that central banks and institutions turn to when confidence in the financial system begins to crumble. And right now, that shift is happening at an unprecedented scale. Nations around the world, especially those outside the Western financial system, are dumping U.S. debt and accumulating gold at record levels. They see the writing on the wall. Fiat currencies are being debased, the debt system is unraveling, and real money, gold, is the only true hedge against the coming collapse. But here's what most people don't realize. While gold is leading the way, silver is the metal with the most explosive upside. Historically, silver lags behind gold in the early stages of a crisis. But when it catches up, it does so with a level of aggression that shocks even the most seasoned investors. Look back at history. In the 1970s, gold surged, but silver outperformed it dramatically, rising from $1.50s to nearly $50 an ounce. The same pattern repeated in 2011 when gold approached $1,900 and silver rocketed from $9 to nearly $50 again. And now, the setup is even bigger. Central banks aren't just buying gold, they're actively repatriating it, moving reserves back within their borders as trust in the global financial system disintegrates. Even whispers of a gold-backed monetary reset are starting to circulate, something that would send shockwaves through the global economy. If that happens, silver, with its deep historical connection to sound money, won't just follow gold's lead. It will explode past expectations. The key question isn't whether silver will surge, but how high it will go when the next leg of this crisis unfolds.
Bang for every buck you spend. So it's very unproductive debt adding, and we need a recession. We've got 9 trillion in rollovers, the United States, that need refinancing. The only way is you're paying more. It's just a question how much. Now, if we get a really big cut, and that's 100 basis points, let me use a fatter Koki there to highlight that. If you get the yellow road, which is the 100 basis points projection, you'll go up to 1.3 trillion. If you're coming in at the current level of rates, rates remain the same, you're at 1.5 trillion over the course of the next year. So you're going from 1.2, you're going to 1.3 to 1.5. And 100 basis points cuts is quite dramatic. You're talking about 250 basis points, which are pretty panicky, 50 basis points, the typical increment being 25. So that points to they probably need the recession. They need to keep the interest rate payment down. And this is the driver behind Zelensky peace talks and the attempt by Donald Trump also to secure something for that which was paid over by Biden in terms of resources. We're actually seeing all major governments trying to seize resources. This is very bullish for commodities, by the way. So Trump is searching for resources in Ukraine in lieu of 350 billion handed over by the Biden administration, and he's looking for peace. Why? Because he doesn't want to fund and can't fund any further. We've had other points. We did a talk in what was called the dollar vigilante. In fact, we highlighted that too many people are now short the ETF. On the slide, I'm just showing the short positioning on the ETF. We were short 2020 at back end of the year. Since then, last year, November, Druckenmiller, Paul Tudor Jones, they declared their hand. That means they put on their position already. By the time they start talking it, they're talking through their pocket. And the whole market has now moved to be short American debt. So everybody's caught up to part of the story a bit too late. They've all run to the wrong side of the ship. What's actually going to happen is recession will flood some money back into bonds, not to the same degree that it did in the CV19. The trust is gone, the faith is gone, but it will flood some. The interest rates will go down. What's actually going to take the leaking of the pressure on with regards to the debt is going to be the currency this time. So the dollar will soften. You have two valves to relieve pressure in this overheating geyser. You have the currency deval and the debt deval. The debt devaluation fell 45. That card's being played. If you do too much more of it, no one will buy any debt at all. So it's time now for the rates to come down and a bit of bid to come back in. So the TLT excess short.
The gold to silver ratio has always been one of the most powerful indicators of where silver is headed next. And right now it's flashing a massive buy signal. Historically, when this ratio reaches extreme levels, silver doesn't just rise, it erupts. The current ratio is hovering between 75 and 92, meaning it takes up to 92 ounces of silver to equal the value of 1 ounce of gold. But here's the key. Every time the ratio has hit these levels in the past, a violent silver revaluation has followed. Look at the data. In 1980, the ratio collapsed from over 80 to just 16 as silver skyrocketed from under $6 to nearly $50 an ounce. In 2011, a similar pattern emerged. Gold was surging, but silver remained suppressed, sitting at a historically high ratio of over 80. Then, within months, silver exploded past 40. Now, the message is clear. When gold makes its move, silver follows, but with even greater speed and magnitude. And this time, the setup is even stronger. Gold is already pushing new all-time highs, yet silver is still sitting at a fraction of its previous peaks. If history repeats, and it always does, then the gold-to-silver ratio is signaling that silver is about to play catch-up in a way that will leave most investors stunned. A return to historical norms would mean silver soaring well past triple digits, but in an environment where fiat currency confidence is collapsing, silver could break beyond even the most bullish expectations. The real question isn't whether silver will follow gold, it's how fast and how high it will go when the breakout begins. And with global financial instability accelerating, that moment is approaching far sooner than most people realize.
Because all the bond money flowed there. It's quite a binary situation since, the advent of the 60/40 portfolio. You don't want to pay over the odds for a ridiculously priced equity that's got 100 plus years of earnings already baked into it in its price. So we've started to revert back to the original reserve asset, and gold is being rediscovered, but not by retail in any meaningful way. It's the central bankers. And it's particularly the central bankers that have to deal with America that have rediscovered it. And more recently, since Donald Trump and Elon Musk has come in, even American central banks rediscovering it, which is probably behind the UK and silver gold. I don't think we've spoken since those movements were occurring. The repatriation of some degree of gold back to America may be the setup for some form of show and tell Fort Knox vault event, let's just say, to rebuild confidence. Because when debt markets fail, it is the underlying foundation of the home that is the fiat debt-based system, and that is confidence failure. You can fail further up and you can have stock market crashes. That's all well and good, and there's many people that have been trained to buy the damn dip, but I can say this is a deleveraging and a right sizing of America, because the possibility and the scope to spend what it spent before, it's not a positive message. I'm sorry, guys. We've had this incredible expansion which has been based on liquidity feeding on liquidity, and now the unwind of that, the Goldilocks Greenspan era, is now facing the J. Powell's let's say Night of a Thousand Knives type era. And unfortunately, it's not very positive. So a couple of charts help lay this out. So let's talk about interest. And I'm going to just share a couple of things straight off the Twitter feed of people I've been paying tribute to. So this, for example, the US interest rates payments. This is the recent move up in interest rates on this particular chart. You can see it's violently up. Your interest rate payments have surged to such a degree that they now dwarf the defense expenditure, and they're 1.2 trillion. My argument is we will have a US-based recession, because actually you need one. It should have been a Biden recession. It should have maybe even been even before that, on the basis that the economy was existing on fumes. Reinhardt and Rogoff have made it perfectly clear that the minute you threw 90% of GDP, you only get about 0.6.
Silver isn't just a monetary metal, it's an industrial powerhouse. And right now, those two forces are colliding in a way the market isn't prepared for. While investors focus on silver's role as a hedge against financial chaos, a much bigger storm is brewing, a supply and demand imbalance that could send prices skyrocketing. Let's talk numbers. Silver is an irreplaceable component in solar panels, electric vehicles, 5G technology, and medical applications. The solar industry alone accounts for nearly 20% of global silver demand, and that number is only growing as governments push aggressive green energy policies. Electric vehicles? They use up to 50 grams of silver per car, far more than conventional gas-powered vehicles. And with global EV production expected to triple by 2030, silver consumption is set to reach historic highs. But here's where it gets even more interesting. Despite this surging demand, silver supply is shrinking. Mining production has been declining for years, and the silver market has now posted multiple consecutive years of deficits, meaning more silver is being consumed than produced. And while demand is rising, there are no major new silver discoveries on the horizon. The silver market is tight, and once investment demand floods in, it won't take much to trigger a full-blown supply squeeze. We've seen this happen before. In 1980 and 2011, silver's price didn't just rise, it spiked violently. That's what happens when a tiny, illiquid market meets massive demand. But this time, the industrial demand is far greater, the supply crunch is deeper, and the monetary crisis is even more extreme. The question isn't whether silver will surge, it's whether the world will have enough supply to meet the coming wave of demand.
Again, a good question. And another point to highlight is I'll start you off on the gold silver ratio, the comparable. And there's only been one moment really in modern history where you've got to 92 and haven't turned down. And that was the events, a very unique set of events. That was CV19. So that was your sell-off when you were there in July. This is when you had a real blow-off, and that was the failure point, and you traded 128. That's ridiculous. It was extreme. And of course, paper, you traded 11. But as people like Bill Holter and others will highlight, you couldn't buy for 11. I think the lowest cost you got was 14 or 15. Every other time we hit 92 on the gold silver ratio, there's been a sell-off. This particular event, we almost let go of the 75, and then it got bought back up. Gold was the aggressor and won out. We just hit 92 again, and we've been rejected again for this. So we're caught in the 75-92 range. As long as we're bouncing around in there, silver's going to roughly replicate gold's return, although it's not done so for the 5 years before. So that's why it's not made the new highs. When you swing down leg from 92 to 75, silver will be outperforming. I think that goes without saying. And when you rally off the 75, it's going to be the gold that's outperforming. What you might get if silver firms up a little more and starts to come down is once the recession is confirmed by the lagging indicator of unemployment, you might then get the gold do better than silver again one more time. But eventually everybody's going to realize it's badly in need. There's been a lot of news about shortages. And eventually, you've got to be able to deliver the goods, and that's the big thing. I don't think we have the deliverable goods. I think that's why we've had a rush on LBMA. We've had the rush to get gold in America. I think we're hitting those skid moments where being able to take delivery and people asking for delivery and trust is gone. And that all goes with the debt market turn, which is what I said was so important. The beginning of the fiat system failure, the fiat and debt system failure, sees trust go away. Now people want to hold. And when people want to hold, they want delivery. And this is a great problem for derivative markets, banks, etc., and anything that's been involved in hypothecation. So let's take you to the silver chart itself, because I've talked everything around it, but without offering it to you. So let's get straight into that. This is a good move up. And I like to look at it on a bigger time frame as well, because what I'll be highlighting to you is that actually on the weekly and even more on the monthly, we're at a monthly current high. When we made the most recent high back in October, we didn't close anywhere near the high. We closed at 32.8.
Silver isn't just a monetary metal, it's an industrial powerhouse. And right now, those two forces are colliding in a way the market isn't prepared for. While investors focus on silver's role as a hedge against financial chaos, a much bigger storm is brewing. A supply and demand imbalance that could send prices skyrocketing. Let's talk numbers. Silver is an irreplaceable component in solar panels, electric vehicles, 5G technology, and medical applications. The solar industry alone accounts for nearly 20% of global silver demand, and that number is only growing as governments push aggressive green energy policies. Electric vehicles, they use up to 50 grams of silver per car, far more than conventional gas-powered vehicles. And with global EV production expected to triple by 2030, silver consumption is set to reach historic highs. But here's where it gets even more interesting. Despite this surging demand, silver supply is shrinking. Mining production has been declining for years, and the silver market has now posted multiple consecutive years of deficits, meaning more silver is being consumed than produced. And while demand is rising, there are no major new silver discoveries on the horizon. The silver market is tight, and once investment demand floods in, it won't take much to trigger a full-blown supply squeeze. We've seen this happen before. In 1980 and 2011, silver's price didn't just rise, it spiked violently. That's what happens when a tiny, illiquid market meets massive demand. But this time, the industrial demand is far greater, the supply crunch is deeper, and the monetary crisis is even more extreme. The question isn't whether silver will surge, it's whether the world will have enough supply to meet the coming wave of demand.
Was in and around 129. 1 ounce of gold bought you 14.8 barrels of oil. Up top here, where if I just move us to the other side, those handsome gents we were looking at there, 61 barrels of oil is our target on an inverted head and shoulder reversal, and you continue. And by the way, for those wondering what's the point of this measurement, gold in terms of oil barrels, it takes the dollar out of this, and it's also very close to what had happened the previous time. I think this is going to emulate the last crash immensely. I think this is going to be a great and dastardly recession. I don't know what theme it will have this time, but this was the inverted head and shoulder we called on gold divided by oil last time. And can I point out that this went infinitely far? So if you'd shorted oil and gone long gold with us way back in 2019, you would have had an infinite to almost zero. In fact, zero in the cash markets, negative in the futures market on your oil short from $67. And you would have at the same time ridden a bull market that went right up to 21 in gold. It was an incredibly powerful trade. And the point I'm making is it's here again. It feels like a copycat environment for this across these two. And the one thing about oil is it's a thermostat for economic activity. I refer to it as the Rockefeller tax on people doing business, packaging, purchasing of Amazon with delivery, all these kind of things. If oil is flat to down and going to spill on a burgeoning recession, and gold is now the real reserve asset unveiled, we pull back the curtain, debt is a liar, it's been exposed, and everybody suddenly sees and realizes gold. This is another time that this trade does exceedingly well. So yeah, let me let you unpack a bit of that, because I took you past a couple of charts there.
While the US debt market is collapsing, another financial disaster is unfolding across the Atlantic. European debt markets are spiraling out of control, and the consequences will send shockwaves through the global economy. Nations like Germany, France, and the UK are facing unsustainable debt burdens, rising borrowing costs, central banks that are out of ammunition. And just like in the US, investors are losing confidence in government bonds, the so-called safe assets that have underpinned the financial system for decades. The European Central Bank, ECB, is in a no-win situation. Inflation is running hot, but if they raise interest rates to combat it, they risk triggering a sovereign debt crisis. Italy and Greece are already struggling to service their debt at current levels. What happens if rates keep rising? The reality is that Europe's economic model, just like the US, has been built on endless debt expansion. Now, with bond markets breaking down and central banks trapped, the only option left is currency debasement. And that's exactly why gold and silver are set to skyrocket. When fiat currencies weaken, hard assets become the ultimate store of value. We're already seeing a shift. European investors are pouring into gold at record levels, and silver demand is following close behind. But the real acceleration will come when the next major financial crisis hits, and faith in government debt evaporates entirely. Western economies are entering a period of stagflation, low growth, high inflation, and rising unemployment. This is the perfect storm for silver. The last time stagflation gripped the global economy in the 1970s, gold and silver saw their biggest rallies in history. And now, with debt defaults looming and central banks running out of options, silver is once again positioning itself as the ultimate hedge against economic collapse.
Right sizing, and you get a rolling contagion. Again, that's why I find it hard to accept those that are saying we're going to get a final melt up. There is no license for QE at this point. Debt is the problem. More borrowing isn't allowable. We've got to have a major hard crash without the QE, without the drugs, a real problem, a real reaction before a long delay and the solution being provided. And that's why I think debt markets down and a dip possible in gold, but macro is very, very positive and remains very, very positive. I'll put it back on the gold chart, and I want to take you to the sister metals of gold as well, just to further build out the story. For some of the other metals, I'm particularly thinking of, we will touch on silver invariably. I'm particularly thinking of platinum at the moment, which has a large industrial component, but this is also looking like it's moving very, very positively. We again, this is a weekly time frame on platinum. That is a very tight squeeze, an incredibly rare metal. So there's 8 times many ounces of silver for 1 ounce of gold, and there's 20 times as many ounces of gold for 1 ounce of platinum. So you're talking about probably about a 160th of the availability of a silver ounce is platinum. Super rare. Squeezing. This only goes up as precious metal. I don't think the industrial demand will be the biggest driver, but there might be some of it, but there will be some precious metal demand as well. Industrial metal aspects has seen silver still lag, even though we've had a good period. And it's the same for platinum. This is why gold is more advanced. And because of the consumer being wrecked, that's why the gold oil ratio has been so good for us. One of our core trades was gold long, oil short. This gives you a commodity neutral. Now, I don't consider gold a commodity, but many people do. I consider it real money. But this gives you a commodity neutral trade. Essentially, when you are down here at the lows, when oil...
The financial system is cracking and the dominoes are starting to fall. Investors who once saw the stock market as an endless money-making machine are beginning to realize that the era of easy gains is over. The warning signs are everywhere. The Nasdaq to gold ratio is breaking down, tech stocks are underperforming, and corporate debt levels are at all-time highs. Meanwhile, the cryptocurrency market, once hailed as the alternative to fiat, is struggling to prove itself as a true safe haven. And this shift is happening at the worst possible time. For years, the Federal Reserve and other central banks kept markets afloat with cheap money. Every dip was met with a flood of liquidity, and risk assets thrived. But now that safety net is gone. Rising interest rates have changed everything, and speculative investments are no longer the easy trade they once were. The days of unprofitable tech companies soaring on hype are coming to an end. And as the economy slows, stock market gains will be much harder to come by. And what about crypto? While Bitcoin has had its moments, it's still an unproven asset in times of true financial crisis. During stock market panics, Bitcoin has often moved in tandem with risk assets rather than acting as a store of value. In contrast, gold and silver have a track record spanning thousands of years. Every time fiat money weakens, these metals rise. That's why central banks aren't accumulating Bitcoin or tech stocks. They're buying gold. And while the mainstream focuses on gold, silver remains the sleeper play with the highest upside. As confidence in traditional markets erodes, capital will flow into real assets. Gold has already broken all-time highs, but silver is still lagging, setting up one of the most asymmetric investment opportunities in history. The time to position is before the rush, not after. The world is waking up to the reality of debt-driven economies, and as they do, silver is primed to be one of the biggest winners of this financial reset.
That had already happened. So that is why when I last spoke to you, I said, we're on notice now for correction. And the lagging indicator, the last, is unemployment. And we're starting to see the houses in Washington, D.C., there's twice the usual amount up. There's a 21% collapse in value. And on the airlines, Government travel has been cut by 50%, and that's knocked on to around a 20% reduction in revenue in certain cases, leading to a halvening of the earnings per share. So the leverage there is very high. That means airlines can go down and you're getting the property squeeze in the localized area. There's going to be contagion from this generally, and that's why I think we're in that stagflationary negative growth even is possible here in real terms. And it's a very fertile environment because nobody is getting any benefit out of currency. In real terms, your currency is losing buying power, and debt instruments in real terms are not delivering you alpha. So this is a very fertile environment for gold, and we've seen the benefits of it. This is a short term after the recent high run. It's a little too short term, I would argue. If you look at the bigger time frames, this is absolutely phenomenal performance. We got the 3,000 run. This was a technically we would call this you had another squeeze. It's been a while since we saw you. This is typically how you go up. We did warn that you'd have a pause period on this target area. You can see you went up, you had a reasonable pull down. It hasn't been for that long, and you wound up, and now you're ready. So we typically expect a continuation pattern in a macro bull, and you got one, and it's traded up. Let me just get that something on the chart there that's just hiding the chart a little bit. So this is up to a more typical daily time frame. So that's brought us to where we are today. We have traded through the 3K, but it wouldn't be surprised if we have a little bit of footsie and messing around on the 3K. The way they can pull us back from the 3K, that remains possible, because as I say, the 2.9 was a very key level. Even though you went a little bit higher, it wouldn't shock me, is recession, because then everything sells off. Anything that's not nailed down to the floor can sell off. And only place to get a bid is typically the bond market. This time, though, much less so. So as we've said, it's higher highs for interest rates and higher lows. You will have a pullback on the rates, for which we can also take a look at the US 10-year just to see how it's going. You will get a pullback on those rates, which points to a little bit of money flowing into the bond market. You can see the pullback on the rates here, which might support the US housing market a bit, but nothing undoes unemployment. If people lose their jobs, they have to sell, particularly in government, and you get localized areas where that starts to form contagion, and then knock-on companies that sell to government have to start.
So how high can silver go? That's the question every investor is asking, and the answer lies in history. Every time the financial system faces a crisis, silver doesn't just rise, it explodes. In 1980, during a period of runaway inflation and economic uncertainty, silver surged from under $6 to nearly $50 an ounce. In 2011, after the financial crisis and a flood of central bank stimulus, silver once again approached $50. And now, with an even bigger storm brewing, debt defaults, currency devaluation, and central banks losing control, the setup is stronger than ever. Analysts tracking long-term trends have pointed to silver's historical price moves and its relationship with gold. If silver were to match its previous highs adjusted for inflation, we'd already be looking at a price well over $150 an ounce. But the situation today isn't just about inflation, it's about systemic failure. With industrial demand soaring, supply shrinking, and paper markets unable to suppress prices forever, silver has the potential to reach levels that most investors can't even fathom. One of the most ambitious targets? $335 per ounce. That number might seem extreme, but when you break it down, it's not just possible, it's logical. If the gold-to-silver ratio reverts to historical norms, and if silver enters the kind of supply squeeze we're seeing signs of today, triple-digit silver isn't just a prediction, it's an eventuality. The market has been asleep on silver for years, but when the breakout happens, it will move fast. Those waiting for confirmation will be left behind. The conditions are aligning for the biggest silver rally in history. The only question is, will you be ahead of the curve or chasing it when it's too late?
I think a gold chart is most certainly due. Before I move on to it, I do just want to highlight that when you devalue a fiat and debt Ponzi scheme, you have the debt and you have the currency, and it's a seesaw. We've had the debt collapse. Now you're going to have a little bit of the currency. So it's a left, right, down, and down, and down. So what's actually happening are both are devaluing. The buying power is devaluing. It's going to be very inflationary. And at the same time, you're going to have a recession. That is your determination of stagflation. It's very poor to weak growth with stubbornly high inflation. There's some people that are getting that wrong. I have some people in mind that are referring to stagflation as, strong growth. It's a poor growth environment inside an aggressive high single digit inflation, and who knows in real terms. So stagflation is incredibly fertile ground for gold. That's what the 70s showed us when Volcker had to devalue the Vietnam debt. What he did is push the rates up, huge debt devaluation. And then subsequently, the currency also took a turn to take a bath after that. And that's what led the gold run up to the $800. So let's bring up the chart and take you into that for sure. I also want to highlight while we're waiting is that you're seeing clear evidence that there is already a beginning of loss of unemployment. Unemployment is a lagging indicator. So whilst we look at the gold chart, I want to highlight we've had the yield curve inversion, which we've spoken about many times with us, a leading indicator. It reverted back positive. So I think the last time we spoke,
We are witnessing the greatest wealth transfer in history, and silver is at the center of it all. The collapse of the debt-based fiat system isn't just speculation, it's happening right now. Bonds are being rejected, central banks are scrambling for gold, and confidence in traditional markets is unraveling. Meanwhile, silver remains one of the most undervalued assets on the planet, but that won't last for long. Throughout history, silver has always played catch-up to gold, only to surge past expectations when the system breaks. This time, the setup is even stronger. Industrial demand is rising, supply is tightening, and the paper manipulation that has suppressed silver for decades is beginning to crack. When the market finally wakes up, silver won't just move, it will go parabolic. Those who understand this shift and position themselves now will be on the right side of history. The question is no longer if silver will break out, it's when. And when it does, it won't be a slow climb. The window of opportunity is closing, and those who wait for mainstream confirmation will be too late. So stay informed, stay prepared, and make sure you're ahead of the coming financial reset. And remember, this is not financial advice. Always do your own research and consult with a professional before making any investment decisions.